Joining us now for more, Peter Supino. He is senior media analyst at Wolfe Research. Peter, you just heard that conversation. Let's kind of follow up from the stock side. Who do you think ultimately ends up with Warner Brothers Discovery, if anybody, and does it ultimately end up being broken up?
Well, in our opinion, it's up to Netflix. Netflix has the most powerful currency in the industry with its stock, and Netflix has such a huge share of streaming engagement that they can make the minutes and hours owned in the Warner library, they can turn that into dollars better than anybody else in Hollywood. Of course, Amazon is extremely well capitalized, and Paramount, Skydance, and Comcast have really powerful arguments for taking a run at these assets before they are never available again.
But didn't we'll get to NBC in a second. Netflix's co-CEO Greg Peters recently say, like a couple of weeks ago, that they effectively were not interested in Warner Brothers?
Yeah, he did say that, and he said in more detail on their last earnings call that it's Netflix's opinion that strategic M&A won't change the competitive landscape significantly in streaming. I'm sure there's truth to what he says, but we need to watch Netflix actions more than their statements because they're inherently, really an innately opportunistic entrepreneurial company, and that's a compliment. And historically, they've said they would never do advertising, and now they're a massive advertiser growing at 100% annually. And they said that they would never do sports, and they went out and licensed multiple sports properties over the last few years. So things are true at Netflix until they're not.
I'm going to kind of quote Peter Supino, back to Peter Supino, because this stuff is not only in my world, but it's a little bit above my world also, if that makes sense, Peter. So as you know, and our audience, I think, knows, CNBC is being spun out with other assets, part of a new company called Versant. What's left of NBC Universal will remain with Comcast. You believe that it's possible Comcast thus spins off NBC Universal, not Versant. We're already going VRST, the new ticker. Spins off the remainder of NBC Universal, creates a new stock, and then that stock is used to buy Warner Brothers Discovery. In that scenario, what happens to WBD's debt? Because the issue is not the quality of their assets, it's how much they owe.
Great question. And yes, we think that there's a strategic opportunity paired with a financial opportunity in the transaction that you just described that we've been writing about for about a year or more in some senses. There's a huge valuation unlock opportunity at Comcast because NBC Universal trades within Comcast at 5.5 times EBITDA and 7 times earnings, which is really stunning considering Disney, which is not an unrelated asset, trades for close to 12 times EBITDA and a much higher earnings multiple. So in that context, yes, the debt at Warner Discovery is a big deal. Warner announced last December that it had begun a process to restructure its corporation and its debts in order to maximize optionality and prepare itself for the possibility of an auction or a breakup like it seems to be beginning. And so we think that they're in a position to move the debts around in whatever way serve their purposes.
A lot of our viewers right now are watching what we would in the industry call linear television. That's good old-fashioned cable TV and throwing some satellite on there as well. We know that those numbers have come down and come down fairly dramatically, Peter. But and I'm probably talking for the home team here, but I think there's a cap. There's a bottom level at which there's going to be millions of people that don't cut the cord because cable is still, it's easy and it works and it looks good and you can find stuff. Am I like drunk or is that a reality in this situation, Peter, where there is going to be a bottom to linear TV? Because that goes in to all the thinking and the calculus that's being done in boardrooms right now.
The decline of linear TV has changed in the last few years from a rapid consumer behavior shift to more of a age cohort driven shift. And the only real thing that's changing dynamically within today's age cohorts is the availability of sports. ESPN launched its direct-to-consumer app in August. Fox did the same thing. The regional sports networks are gradually finding their way into streaming environments. And with that, the last case for the differentiation of linear TV is starting to crumble. Having said that, I mentioned age cohorts. there are our surveys show that people over the age of 55 are inclined to keep linear pay TV for the foreseeable future. And in that way, we think of linear pay TV as Coke and Diet Coke, and streaming is more like Monster, Red Bull, and pick your enthusiast variety of energy drinks.
That's well said. I was thinking Celsius. I'm more of a Spindrift guy, but I kind of appreciate the analogy and the metaphor.
I've been known to venture into Ghost.